Correct. Right. Okay. We will start this paper, right? So we are going to do some accounting revision, right? So we have prepared a small paper and we'll try to do this paper. Okay. Right. We'll look at the first question. Which of the following statement is correct? Which is the following statement is correct in relation to primary function of financial accounting? Primary function of financial accounting. So you'll know that in financial accounting, your primary function is to provide financial information, to the stakeholders of a business. And why are we providing this information? So that they can take economic decisions. So we'll look at what is the most feasible answer. It records the transactions in the books of accounts in monetary terms. That may not be the primary objective. It prepares general purpose financial reports for the use of managers, not only the managers. It prepares general purpose financials for the use of stakeholders. That would be ideally the correct answer. It provides past and future information to the owners, not only to the owners. It provides financial information for the annual audit. No, that is not the primary objective. Okay, so now you're clear with the primary objective of this accounting. We look at the second one, right? What is the correct sequence in which of the following activities take place in a accounting process? So you got A, occurrence of the transactions, posting of journal entries to the ledger, recording of the transactions in the prime entry books, preparation of trial balance, balance in the ledger accounts. We'll take them in the order. So first of all, A, transaction need to occur. Thereafter, what will happen after the transactions? You need to record them in the prime entry book. So that is C. Afterwards, you are going to post them to the general ledger. So B is the answer. Then you need to balance the ledger, that is E. And finally, you need to prepare the trial balance. So ACBED. ACBED number 2 is the correct answer. Number 2 is the correct answer. Okay, right. Look at the third one. What is the main accounting concept? What is the main accounting concept related to recognition of depreciation? Lamai. Now, when it comes to depreciation, you all know what is depreciation. Depreciation is if you take a property, plant, and equipment, the depreciable value, that is the net cost, you are going to allocate among the useful life. You are going to allocate among the useful life. Ne? So there are a number of accounting concepts that are relevant to depreciation, but the main accounting concept would be the matching concept. Matching concept. Why? Because if you take let's say a photocopy machine, this particular photocopy machine would give you income for 5 years maybe. So you are generating income for 5 years. You are generating sales for 5 years. So you cannot allocate the entire cost of the asset in a single year. Let's say 500,000 worth of asset, you cannot allocate over a single year because it does not match. You are recognizing an income over a period of 5 years, but you cannot allocate the cost to 1 year. So you need to allocate the cost over a period of the useful life as a depreciation. So I would say the correct answer would be matching concept. Okay, matching concept. Right. Let's look at the next one. Which of the following accounting concept provide the basis to recognize sales revenue? Basis to recognize the sales revenue related to goods in the statement of profit or loss at the point of delivery of goods to the customers. At the point of delivery of goods to the customers. Ramai, I hope you all can remember we have an accounting concept called realization. What does this realization concept says? You can recognize an income, when the legal right to receive money is established. When the legal right to receive money is established. When the legal right to receive money is established. Is established. Right? When is this legal right to receive is established? There are basically goods and the services now. When it comes to a good lamai, the seller can recognize the income. Seller can recognize the income when the seller's responsibility is honored. When the seller has honored his responsibility. So that is where at the point of delivery. At the point of delivery. Once the items are delivered to the customer, then the responsibility of the seller is over. No? Seller is responsible to give that item to the customer. Service, it occurs over a period of time. So the service income you can recognize over the period of service, over the service period, over the service period. Therefore, the realization concept is a concept that helps you to recognize the income or the revenue. So in this case, the answer would be the realization. Answer would be realization. Okay? Right. Let's move on to the next one. Right. Look at here. Which one of the following are considered as fundamental qualitative characteristics of financial information as per conceptual framework for financial reporting? Right. Now, in the conceptual framework, we need the information to be quality information. No? Financial information shall be quality information. So, in order to be a quality information, there are two types of qualitative characteristics as fundamental and enhancing. Fundamental will decide whether the information is quality or not. Enhancing will decide whether to increase the quality or to have a low quality, right? In order to be a quality information, you need to have the fundamental QC. In the presence of enhancing, the quality will either increase. In the absence, it will decrease. There are basically two fundamentals. One is relevance. One is relevance. Other one is what we call faithful representation. Faithful representation. Relevance and faithful representation. And there are four: enhancing, comparability, verifiability, timeliness, and understandability. Right? So this question they're asking about the fundamental QCs. The answer would be relevance and faithful representation. So relevance and reliability, this and that are there. If you look at the last one, faithful representation and relevance is there. Faithful representation and relevance is there. Okay. Right. Then we look at this question here. A firm has purchased goods with a list price of 600,000. List price 600,000 on credit. Subject to a 5% trade discount. Subject to a 5% trade discount. And thereafter sold for rupees 650,000 on cash. The amount due to the creditor has not been settled. Net effect of these transactions. Right? So we got asset, liabilities and equity, no? Assets, liabilities and equity. First of all, if you take the goods 600,000 subject to a 5% trade discount. So this 600,000 you need to take after trade discount means 100 minus 5 means 95%. You need to take 95%. Ne? You need to take after trade discount. No? Then it will be 570,000. So you are purchasing 570,000 worth of items. So the assets goes up, liability goes up, 570. Then you are selling them for 650 on cash. So 570 worth of items, you are selling them on 650. So when you are selling, the inventory comes down and you are getting cash. So 570 worth of item is sold at 650. You are recognizing a profit of 80. So then here you got 650, 570 and 80. Let's look at the answers. Assets increased by 650, either these two. Liability, yeah. Then the fourth one is the correct answer. Fourth one is the correct answer. Right. I hope the idea is clear. These questions are pretty easy, right? Especially when it comes from the counting equation lamai, very easy to answer, not a difficult question. Okay, right. Let's look at the next question. Right. So let me take a blank page to answer this question then. Right, no worries. Okay, let me try to answer the question. Right, let's see. As at 31st of March 2025, the balance of the creditors control account of Tanuja PLC was 360. 360 is the creditors control account. The total of the creditors balance as per the creditors ledger was 406. Creditors ledger 406. The subsequent investigation revealed the following, right? So there are like several findings. The correct balance in the creditors control account. That is what we need to calculate. So we'll take the creditors control account balance is 360. So we need to do the correction. We'll take first one. An interest of 10 charged by a supplier on an overdue balance has been recorded only in the creditors ledger. So there's a 10 rupee charge that has been charged upon the creditors, and that is recorded only in the creditors ledger. Now if you take the control account and the creditors ledger account, this is recorded only in the creditors ledger, not in the control account, but you have to record it now. So the creditors balance will increase. So you have to add 10 rupees. Right, look at the next one. The total of the purchase journal 62 has been recorded in the creditors control account as 26. Right? So 62 has been recorded as 26. So ideally you should have recorded 62, but they have recorded only 26. That means 36 rupees, there's an understatement. So it's a purchase journal. No? So because of the purchase, the creditor balance should go up. So the creditor's balance should increase by 36. Creditors balance should increase by 36. Right. In the last one, 28,000 paid to a creditor has not been recorded in the creditors control account as well as the creditors ledger. 28 payment, when you are making the payment, the creditors account should come down. It has not recorded in two places. So we are looking at the correct control account balance. So we need to deduct the payment. It's very easy. We need to deduct the payment. So 360 plus 10 plus 36 minus 28. I'm getting an answer 378. So the answer would be 378. 378 is the answer. Okay. Right. So they are asking you to calculate the creditors control account, the corrected balance. So we looked at the items, then we do the correction as plus and minus. Very easy. You don't have to open up a T account to do this. Just can do on a plus minus basis. Right. Okay. Next one. The trial balance of the Chatura PLC did not balance. The subsequent investigation revealed the following. You are supposed to calculate the suspense account before rectifying the errors. Now for this, actually easiest way is to prepare the suspense account. You can do it even without the suspense account, but This way would be a little easier. Let's see. First one, a cash sale. We are opening up a suspense account. Cash sale of 100,000 has been recorded only in the cash book. A cash sale of 100,000 has been recorded only in the cash book. Now, ideally, if it is a cash sale, you should have recorded debited to cash, credited to sale. 100 rupees each. This is what you should have recorded. What they have recorded is only in the cash. What they have recorded is debited to cash. This has not been recorded. Then we need to record it now. Credited to sale. So we need to pass a double entry. Credited to sale and debited to suspense account. So the suspense account will be debited 100 as sale. Suspense account will be debited 100 as sale. Okay. Right. Look at the next one. The purchase journal has been undercast by 60. Now, the question clearly says the purchase journal has been undercast. Undercast means you have totaled it lower by 60. Undercast ke liye aduwen ekathu karana කියන එක. So the purchase journal is been undercasted by 60. Purchase journal is undercasted by 60. Journal එක අඩුවෙන් එකතු කරලා. When a total of the journal is been undercasted, when the total of the journal is been undercasted, then it will impact both accounts, both purchase account and the creditor account. That will not impact the suspense account. Suspense account and එක entry එක අවුලක් ආවොත් නේ. එක entry එක අවුලක් ආවොත් yes. But here both entries have the error. Right. Look at the next one. Bad debt recovery 30 has been recorded as an expense. The bad debt recovery එකක් නම් කොහොමද දාන්න ඕන double entry එක? If it is a bad debt recovery, debited to cash, bad debt recovery credited. Credited 30 rupees. මේ තමයි හරියටම දාන්න ඕනේ entry එක. Bad debt recovery means you are getting money from the debtor who has been written off now. So the cash goes up. On the other side, credited to bad debt recovery. Now this is the correct entry. What is the wrong entry they have put? Wrong entry. කොහොමද යාලා දාලා තියෙන entry එක? Bad recovery 30 has been recorded as an expense. දැන් යාලා cash එක දාලා ඒ ගැන මුකුත් කියලා නැහැ. Debited to cash 30. They have debited the bad debt recovery 30. They have done two debits. මේ වරද්දලා bad debt recovery එක expense එකක් විදියට දාලා. So you can see there's nothing wrong with the cash side. Cash වල අවුලක් නැහැ. Amount to be credited, they have put that as debit. So කොහොමද මේක අපි දැන් correct කරන්නේ? So in order to remove this and to recognize the credit, so we need to credit the bad debt recovery 60 and debit it to suspense 60. Suspense එකට debit වෙනවා 60ක්. Bad debt කියලා. නේද? Bad debt recovery. Bad debt recovery 60. Okay. Right. Look at the next one. An interest income of 10 has been credited twice in the interest income account. The interest income account you should have recorded as debited to cash, credited to interest income. මෙයාලා මොකද්ද කරලා තියෙන්නේ? cash වල අවුලක් ගැන මොකුත් කියලා නැහැ නේ. Debited to cash, credited to interest income 20 නේ. වැඩිපුරත් එක්ක දාලා 10ක්. මේක හරි. මේ වැරදි වුණාම දාන entry එක. cash වල අවුලක් නැහැ. There's nothing wrong with cash. Interest income you should have credited only 10 but you have credited 20. එහෙනම් කොහොමද අපි correct කරන්නේ? Debited to interest income 10 credited to suspense account 10. So the suspense account will be credited 10 rupees as interest income. Total මේ මෙතන 160යි 10ක් ගියාම suspense account එකේ balance එක එනවා කීයද? 150. So 150 credit balance. Yeah. For the suspense account, we are getting a balance of 150, a credit balance. 150, a credit balance. Suspense account, you are getting 150 a credit balance. Okay. Right. Okay. We'll move on to the next question then. Right. Look here. The following information relates to the acquisition of a machine 31st of March by a business registered for value-added tax. Business is being registered for value-added tax. Price paid inclusive of VAT. Price paid inclusive of VAT. Now, Lamai, if you take the price, VAT and price with VAT, right? There are three things. Now here they're saying there's a VAT rate of 11%. Now without VAT price would have been 100. No, VAT is 11. Then the VAT inclusive price would be 111. If you put the percentages something like this. Before VAT 100%. VAT is 11%. Then the after VAT would be 111%. So if you take this 777, that is 111%. Then we need to figure it out. Then how much is 100%? That is before VAT. And how much is the 11%, which is the VAT figure? You can easily calculate, right? You can easily calculate. So how do we calculate this one? Before VAT figure. If 777 is 111, how much is 100? Okay. You can easily calculate now. 700 here. And this one would be 77, right? How do we get that? 777 divided by 111 multiplied by 11. So you can see of this purchase price, VAT inclusive is 777, but when you exclude the VAT, it will be 700. So for Aslamai, if it is a VAT registered company, we have to always remember whatever the VAT figure, we are going to deal with that in the VAT control account. That goes to the VAT control account. So our the purchase cost would be this 700. Okay, 700. Right. So there are some other items as well. They are asking you to calculate the cost of the machine at initial recognition. So from this 777, what we need to take is 700. Because the amount you are paying to purchase the asset, will be part of your cost anyway. That we have to take. Transport cost from the port to the business premises. Transport cost from port to the business premises, you have to incur now. Now when you are importing a machine, without transporting it to your premises, you can't use it. No. For you to use it, you have to transport it. So that is a must. So the 70 is also part of my cost. Cost of site preparation. Now for you to install a machine, you need to arrange the premises. No. මැසින් එකක් කියනවා නම් එතන බිම කඩන්න වෙයි, බිමට කොන්ක්‍රීට් එකක් දාන්න වෙයි, වහලේ හදන්න වෙයි. So you need to arrange the premises. That include a cost. Without arranging the premises, you cannot bring that machine. You have to incur that cost. So that is also part of your cost. Cost of installation. Now we have arranged the premises. Now we are trying to install the machine in that premises. It comes with a cost. For you to install, it incurs some material cost. You need people, you need technical people, you need professionals. Yeah, that is also coming with a cost, 80. Expenses of the opening ceremony. Now you have purchased a machine and you want to put up an opening ceremony. To cut down that ribbon, to have some music groups, the dancing groups, and to invite a guest and all. These are not essential, right? You can just use the machine without an opening ceremony. And these are admin things, no? Doing an opening ceremony is an administration task. So that is not part of your cost. That's an expense. Next one. Operating cost of the initial testing. Now, once you have bring down the machine lamai, sometimes you have to do the initial test run. You need to do a test run and see whether the machine is working. So for that test run, there are certain expenses you have to incur. Some are operating. That means some are expenses which are you are incurring in your routine days, right? The material cost of that particular item, right? The labor cost involved. Those are operational costs, no? Say it's about let's say that machine is cheese production machine. So for you to manufacture the cheese, you need to use this milk, no? That's an operational cost. Then the employees who are working in that machine, the labor cost, those are operational cost. That operational cost you cannot capitalize to the asset. You cannot add that to the asset. But there are some capital cost in an initial test run. Let's say this cheese production machine you imported from Switzerland. Then you're bringing down some Swiss technicians, Swiss professionals for them to observe the initial test run to get an idea, to get their support if something goes wrong. Now that is a one-off cost. You are not going to bring down Swiss technicians and the professionals every day, only for the first run, right? So the capital cost is yes, but operating cost, no. Then you can take the total now. So I'm getting an answer of 970. So 970, fourth one is the correct answer. Fourth one is the correct answer. Fourth one is the correct answer. Okay. I hope you got the idea. Clear? Right. Okay. So if you have anything to be asked, please you can put that in the chat or you can answer. Right? Ah, right. We'll look at the next question, Lamai. The following information has been extracted from the payroll of a manufacturing company. What is the meaning of payroll, Lamai? When you're paying the salaries, we need to accumulate the information about their salary. What are the additions to the salary? What are the deductions? Right? Then you are putting the total employee related cost into a document. So this document is called the payroll. Right. Now you got the payroll of the production workers separately, production supervisors separately. What are the amounts of direct wages? Come on, direct wages. Now, if you take the manufacturing account, right? Manufacturing account, the cost can be divided into two. One is the direct cost, other one is the overheads. Direct costs include the direct labor, direct material, and direct other, right? Direct other costs. Overhead costs may include some variable production overheads and fixed production overheads. Like that, different costs are there. They're asking what are the costs to be included inside the direct labor cost and the production overheads. Let's see. Okay, right. We'll take one by one. Neither. We'll take the direct wages first. Now the production workers are the direct employees now. This goes to direct wages. Production supervisor. Direct wages are the people who are directly involved in the production process. No, they are anyway in the production process. They are the ones who change the shape and the what is it, the composition or the context of the product. Therefore, these are the direct employees. Supervisors, they do not engage in the direct production, they supervise. So therefore, they are the overheads. These are the production overheads. We'll see what are the items that we need to take. 4,000, the basic salary, that is part of your salary cost that you have to take. Let me first of all take the direct wages. Incentive payment based on the piece rate. Piece rate of a special order. I mean, what is meant by piece rate? Piece rate means this incentive is given based on the number of items you manufacture. That's a production relevant, production based payment. No? Piece rate. You are being paid based on the number of items you manufacture. Therefore, that is also part of your direct wage. Overtime is not there. Bonus paid on company profit. If there's a bonus paid on company profit, then profit is something, the profit based bonuses is an admin task. No, the administration or the management is deciding to pay a profit bonus. That's an admin expense. It may be paid to the production employees, but that decision is an administration decision. It's not relevant to your production. You are not paying bonuses based on the number of items. It's based on the profit. Therefore, this is an admin expense. This is an admin expense. This is not coming. This is an admin expense. Gross salary. That is basically the total now. We have taken the item to item. Deductions. EPF contribution. Now, we know from the salary of an employee contributes to EPF now. You know that, right? So from the salary of an employee, 8% will be contributed by the employee. Right? Now, that is already covered in his salary expense now. Right? So that is already there. From this 4,000, you are going to pay here 10%. So this, when you take 4,000 as our salary cost, this 400 is anyway included. It's included. Salary එක 4,000 employee ට ගෙවන්නේ 3,600යි. 400ක් යනවා central bank එකට. එහෙම නෙවෙන්නේ. To the EPF department. Therefore, this is not a separate cost to the company because it is contributed by the employee from their salary. Employee salary එකෙන් contribute කරන එක company එකේ cost එකක් නෙවෙයි. හරිද? එයාගේ salary එක අපි 4,000න් අපි යාගේ අතට දෙන්නේ 3,600යි. ඉතින් 400 අපි central bank යවනවා. ඒක. And this net salary is basically the difference. Then this EPF lamai. EPF 600 and the ETF 120. These two are part of your employment cost. ඒක අපේ employment cost එකේ කොටස. ආයෙත් මොනවද ඉන්නේ direct wages වලට 4,000 1,005 600 and 120. So the items will include 4,500 plus 600 plus 120. I'm getting 4,000 plus 1,005 plus 600 plus 120, 6,220. I'm getting an answer 6,220. That's this year which side? You're getting the answer right. එකයි නේද? 6,220 තියෙන උත්තරේ මැවිල්ලත් ඉවරයි. හරිද? Right. Anyway, we'll check the other answer as well. Production supervisor salary is taken. There's no this one. Overtime we have to take. Overtime is part of your cost. Bonus, this is an admin expense. This is basically the total, no? These are the total, no? EPF is not an expense. EPF employee is not an expense, right? Of the business that is contributed by the employee. Then the EPF employer contribution, 300 we have to take, and here 60. Ne? අහන මෙතන එනවා ළමයි 2,000 plus 800 plus 60 and 300. 2000 plus 800 plus 60 plus 300. 3160 is the answer. Yeah, 3160 is the answer. Okay. 3160 is the answer. Right. Okay, we'll look at this question number 11, 12 and 13. Right. Dingalika traders purchase goods for rupees 44,000 on a credit basis. 44,000 on a credit basis from Samayan traders. The price includes 10% VAT. Price includes 10% VAT. And out of these goods at a value of rupees 20,000, excluding VAT, were returned to Samayan traders. 50% of the remaining goods were sold for rupees 33,000 to Amila's business, including a VAT of 10%. Rupees 31,000 was received in cash from the receivables, and the remaining receivable amount was written off as a bad debt. VAT liability was settled by rupees 200. VAT liability was settled by rupees 200. Okay. Select the answer which contains the correct order of source document used to be recorded the above transactions in the accounting books of Dingalika traders. Right. First of all, you are purchasing goods on credit now. Then you have the purchase invoice. Then rupees 20,000 worth of goods were returned. Purchase return means debit note. %50 of the remaining goods were sold for Amila. Then that is sales invoice. 31,000 cash received. Right? Cash received means cash received. And the remaining receivable amount was written off as a bad debt. Then there is journal voucher. Right? Okay. Final one, cash liability was settled, payment voucher. See. Right. Look at the most appropriate answer. So you can see the fourth one starts with the sales invoice. Then that's not an correct answer. Out of the first three and the last one. So after the purchase invoice, then we need to look at the debit note. So then it should be either second one or the fifth one. Now others are out now. Then the third one would be the sales invoice. That's correct. Then the fourth one would be the cash receipt. That is also correct. Right? Purchase invoice, debit note, sales invoice, right? Then the receipt. After the sales invoice, receipt. Here they got the voucher. So this is not the correct answer. So the most appropriate answer would be the fifth one. Purchase invoice, debit note, sales invoice, receipt and the journal voucher. Receipt and the journal voucher. Okay. Right. Okay. Right. Let's see the other two questions. You're done with the first part. What is the balance of the VAT account after the above transactions? So we need to open up the VAT account. What is the increase or decrease in the net assets due to the above transactions? Let's see. First of all, you are purchasing 44,000 including a 10% VAT. So if it is 44,000 including VAT means that is 110, no? Then the VAT amount would be 44 divided by 110 multiplied by 10. It will be 4,000. So when you are purchasing, you are supposed to pay that VAT to the government. When you are purchasing, whatever the VAT amount paid, you can recover, right? Whatever the amount paid, you are going to recover. So then that will be debited to VAT control account. So the VAT control account will be debited 4,000 for the purchase. The creditor. Right? Let me put that as creditor. Then rupees 20,000 excluding VAT per return. 20,000 excluding VAT per return. So if it is 20,000, the VAT amount would be multiplied by 10%. 2,000 worth of VAT got returned. So then you have to credit that figure now. So 2,000 I am going to credit. So when you are purchasing, you can recover the VAT. When it is returning, it will come down. Okay. Right. Then what? 50% of the remaining goods were sold for rupees 33,000 to Amila's business. Now we are making a sale, no? 33,000. 33 including a VAT of 10%. Then 33 divided by 110 multiplied by 10 is 3,000. So you got a VAT of 3,000. Right? So whatever the VAT you are collecting from the customer, you have to pay it back to the government. So then the VAT figure would be 3,000 from the debtor. Okay. Finally, they are saying VAT liability was settled by 200. When you are settling the VAT liability, cash credit debited to VAT control account 200 cash. Let's try to close the T account. 5,000 here minus 4,200. 800. We have a 800 rupee balance, which is a credit balance. Balance, right? This is not a debit balance. We need to look at the balance carried down, 800. So 800 rupee, we have a credit balance. 800 rupee, we have a credit balance. Okay. Right. Next one, they are asking, what is the increase or decrease in the net assets due to the above transactions? Increase or decrease of net assets. So here there's no additional capital or drawings. So purely the increase or the decrease in the net asset should be due to the profit. We need to look at the profit of this transaction. Okay. You are purchasing, you are returning, we don't care. We need to look at the sale. 50% of the remaining goods are sold. Now you purchased 44,000 worth of items, right? And excluding the VAT, it's 40, no? Right? And out of these goods, 20 were returned. Making visa ka bhi return kara. 50% of the remaining goods. The remaining goods is 20. 50% of the remaining goods means 10 worth of items. Making zero pana can the 10 rupee worth of items were sold for rupees 33 including VAT. That means here your purchase cost is 10. You are selling that at a value of 33, that is with VAT. Without VAT it's 30 now. So then you are keeping a profit of 20. Here you are keeping a profit of 20. Keeping a profit of 20. Right? 31,000 was received from Amila and you have made a sale of 33 to Amila. 31 was received from Amila and the remaining balance was written off. That means out of 33, 31 is received, 2000 is a bad debt. So 2000 is a bad debt. 2000 we have deducted as a bad debt. Right. So then we can see there's a profit of 18,000. Would increase by 18,000. That would be the correct answer. The profit would increase by 18,000. Okay. Right. Total cost of a product is equal to the sum of. If you take the cost of a product, there are basically two areas. One is the direct cost, other one is the overheads. Direct cost, direct material, direct labor and direct other. Overheads, variable production overheads, fixed production overheads. Let's look at direct cost and the production overheads. Total cost of a product. Direct total cost of a product. Yeah, here they are asking the total cost of a product. This is the production cost. Right? This is the production cost. Okay. Then they are asking about the total cost now. So if you take the total cost of a product, yes, one side we have the production cost. Then there are some other overheads, neither. Non-production overhead that even we need to factor here. Non-production overheads, the administration cost, marketing, right, the finance, sales, marketing relevant expenses, other expenses. There are some non-production overheads as well, no? That even we need to factor. So here you might think, okay, direct cost and the production overhead, but here it's not total production cost, it's the total cost. So first one is not the correct answer. This covers only the production overheads. What is happening to non-production overheads then? Direct cost and variable overheads. Not only variable, there are fixed as well. Prime cost is direct cost and the variable overheads now. Prime cost and the periodic cost. Here the prime cost is the direct cost. Periodic cost are the non-production overheads. Periodic cost means non-production overheads. Then this does not cover the manufacturing overheads. Manufacturing overhead cover prime cost, that is the direct cost, variable overheads and the fixed. So these production and the non-production, all these overheads can be categorized as variable and fixed. So the correct answer would be the fifth one. Fifth one is the correct answer. Right? Fifth one is the correct answer. Okay. Right. Prime cost, variable overheads, and fixed overheads. Right. We'll look at the next one. Indicate whether the following statements related to the role of management accounting of a firm is true or false. It provides information to the managers. Yes. True. It provides both past and the future information. True. It provides information prescribed in accounting standards. We don't have accounting standards for the management accounting. It provides information on demand for all the stakeholders. No, we don't provide for all the stakeholders in the management accounting. Okay. Right. We look at the next one, question number 16. Sumudhu has commenced a business investing 500,000 cash. During this, Sumudhu provided 200,000 worth of photocopier for the business and withdrew 50,000 from the business's drawings. The business earned a profit of 120. State the two items that contribute to increase the equity. Increase the equity, the additional capital of photocopier, 200,000. Because of the additional capital, the equity goes up. When owner is investing, equity balance goes up. Equity means amount payable back to the owner. No? When the owner invests, we have to pay it back. And the profit. Profit is something earned by the business for the owner. So this you have to add that to the equity. What are the net assets of the business as at 31st of March? Right, you started with 500, then you invested 200, then we withdrew 50 and earned a profit of 120. So we are arriving at 770. 770,000. So the answer would be rupees 770,000. 770,000. 770,000 is the answer. Okay. Right. Says the source document applicable to the following prime entry books. Sales journal, source document is sales invoice. General journal, journal voucher. Cash payment journal, payment voucher. Purchase return journal, it's very easy to remember. If it is purchase return, purchase, it's expense debit, no? Then it's a debit note. Purchase non-debit, purchase non-debit. Purchase return, no? Debit note. The logic is the other way, Purchase return, you are purchasing on credit. So when you purchase, the creditors will increase. In a purchase return, the creditors to come down, we have to debit. That's the logic. But you can remember that as purchase return. Purchase is debit, no? So therefore debit note. Sales return. Sales is credit, no? Therefore credit note. Right? Okay. Right. Look at question number 18. State four types of transactions or events relating to property, plant, and equipment that would be recorded in the general journal of a business. That would be recorded in the general journal of a business. So it may include property purchased on credit, property sold on credit, then property, plant, and equipment revaluation, property, plant, and equipment impairment, then depreciation. Right. So property, plant, and equipment related double entry related transactions that are recorded in the general ledger. That include PP purchase on credit, PP sold on credit, depreciation, revaluation, impairment. Impairment means the value decline. For an example, if a vehicle met with an accident, because of the accident, the value should come down. That loss is called the impairment. Right? Ah. So you got the answers. Hmm? Right. State the accounting concept that are applicable in presenting the information indicated below with the letter A, B, C, and D. Income of Ahmad, compressed income of Ahmad PLC. Ahmad PLC A. So the A shows the name of the entity, no? So that is business entity concept. Business entity concept. Right? Statement of comprehensive income for the year ending 31st of March. It shows a period, periodicity concept. Periodicity concept. Rupees money measurement. Money measurement concept. Then they have put two D's for revenue and the cost of sale. Revenue and cost of sale comparison that comes with matching concept. Some might think, okay, for revenue it should be realization, but here you have two D's, no? Revenue and the cost of sale. That comparison is coming from the realization concept. Okay. Right. Look at question number 20. State the three characteristics of a liability as per the conceptual framework for financial reporting. As per the conceptual framework for financial reporting. So what are the liabilities? What are the characteristics of a liability? So in order to be a liability, you need to have a present obligation. You need to have a present obligation, right? And there should be past obligating events. Past obligating events. It can be a transaction or an event. Third one, there should be a probable outflow of economic resources. Outflow of economic resources. Right. In order to be a liability, you need to have a commitment today. You need to have an obligation now. You should have an obligation as of now. There should be a present obligation. This obligation should have resulted due to a past obligating event. It can be a transaction, it can be an event. As a result, there should be an outflow of economic resources. For an example, you signed a loan agreement, past event. Now you are obliged to settle the loan, present obligation. At the point of settling, there will be cash outflow, right? So that is what we call the features of a liability. Clear? Present obligation, past obligating events, probable outflow of economic resources. Right. Look at question number 21. The following information relates to Sonimal's business, manufacturing school bags. You got the raw material purchases, direct wages, raw material closing inventory, work in progress, production overheads. Calculate the prime cost. Now you take the raw material purchase. For you to calculate the prime cost, you take the raw material purchase 500. Then there's a raw material closing inventory that you need to deduct, no? Minus 100. Plus the direct wages 200. The closing work in progress valued at prime cost. Closing work in progress is not completed yet, no? That you need to deduct. Okay. Now you have purchased raw material worth of 500. Of that 100 is not used, no? That is the closing inventory available, no? You haven't utilized for the manufacturing process. So really speaking, even though you purchased 500, what you consumed is only 400. What you consumed is only 400 for the production process. Then you incur 200 worth of labor, right? So altogether, 400 and 200, 600 was incurred, right? Even of those 600, 150 is still work in progress. It's not completed. So really speaking, of this 600, what we really completed is only 450. It's a completed. Okay. So raw material we use 400, we use labor 200, but still 150 is in process. What we really completed is 450. So my prime cost is 450,000. Production cost. So my prime cost is, prime is 450 and the production overheads 450. Production overheads 450. So the total here would be 900. Production cost 900,000. 900,000. Right? Okay. Let's look at the next one. State two items that are presented under the equity. If you take the equity lamai, we have the capital and we have the reserves. And someone can say the drawings, Someone can write this like this as well. The capital, the profit, and the drawings. This is also even correct. Someone could have write this as stated capital, retained earnings, revaluation reserve. So depending on the type of the entity lamai, this varies, right? Sole prop, you got the stated capital and the profit and the drawings. Then in terms of a partnership, you have the capital accounts and the current accounts. Companies, you got the stated capital and the reserves, like that. But all are talking about the more or less the same thing, right? Okay. Look at the next question. The balance of the bank account of a business 31st of March was higher than the balance appeared in the bank statement. That means your cash book higher than the bank statement. Higher than the bank statement. Assume there were no errors either in the bank accountant of the business or in the bank statement. So here the cash book balance is higher and there's no error. There's no error than the bank statement balance. Than the bank statement balance. What are the possible reasons for this difference? What are the possible reasons for this difference? So your answer should be your cash balance should be higher, your bank statement balance should be lower. Now for an example, if there's a standing order, what will happen? Because of the standing order, the bank balance would come down. If there are bank charges, then the bank statement balance would come down. Then there can be OD interest. Because of that, the bank statement balance would come down. So what are the reasons for the cash book to have a higher balance? There can be unrealized deposits, right? Because of the unrealized deposits, the bank balance would be higher. So you need to figure out the reasons where the cash book balance is high. Because of the unrealized deposits, it has not come to the statement yet. Or why the bank statement balance is lower. There are standing orders, bank charges, checkbook charges, interest expenses, like that. Right? Very easily, you can arrive at the answers. Right. We'll come to the next question. Use the following information to answer question number 24 and 25. The balance of the creditor's control account of a firm was 600. However, the total was not agreed to the creditor's list. Following were revealed later. A credit purchase of rupees 420 has been recorded in the purchase journal as 240. Has been recorded in the purchase journal as 240. How much is the difference? 420, 240, 180. This has been recorded correctly in the creditor's ledger. There's nothing wrong with the ledger. A creditor's amount of rupees 60. A creditor's amount of rupees 60 has been missed when extracting the balances of the creditor's ledger. When extracting the balances of the creditor's ledger. A discount received of rupees 20 has been correctly recorded in the general ledger. It has been correctly recorded in the general ledger, but it has not recorded in the relevant creditors account. It has not recorded in the relevant creditors account. The total of the return outward, that is purchase return journal, of rupees 10 has not been recorded in the creditors control account. Right. They ask in the total of the creditors ledger account extracted from the creditors ledger before rectifying the above errors, before the errors, and the correct balance of the creditors control account. Right. These are the two they are asking. So we need to calculate the creditor ledger before errors. Creditor ledger before errors. Then the creditors control account after errors. These are the two things we need to calculate. And we will start with the balance 600, the control account balance. Control account has a balance of 600. Okay, right, we'll see. First one. A credit purchase of 420 has been recorded in the purchase journal as 240. However, this was correctly recorded in the creditors ledger account. Right, now ideally you should have recorded a purchase of 420, but they have recorded only 240. In the creditors control account versus creditors ledger, control account, creditors ledger. Creditors ledger 420. Control account they should have recorded 420, but they recorded only 240. They not correct, we need to add 180. So we need to add 180. This is purchase journal. Anyway, the creditors ledger before the errors means the ledger balance no. This error was not there in the ledger no. So even here we need to add 180. Here we are going to correct. But to come out at the ledger balance without the ledger errors, then it should be 180 we have to add. A creditor's amount of rupees 60 has been missed when extracting the balances. So that omission, creditor's ledger, the omission, that is not impacting the creditor's control account. So that 60 rupee we are going to deduct from the creditor's ledger. We are trying to come from the control account to creditor's ledger balance. Control account to ledger balance, right? A discount received of 20 has been correctly recorded in the general ledger, but it has not recorded in the relevant creditor's account. Now, when you receive a discount, balance should come down. When you are receiving a discount, your creditor balance should come down. Creditor's control account properly deducted. Creditor's control account properly deducted. General ledger means control account, no? But in the relevant creditor account, it has not been recorded. So the creditor's ledger balance is high. It's a discount received. Control account you deducted, not recorded in the creditor ledger. From where to you are going now, you need to find the creditor's ledger balance before correction. Then you need to add that discount. Then we will add the discount received. Discount received 20. Right. Finally, the total of the return outward journal 10 has not been recorded in the creditor's control account. Total of the return journal of 10. Return journal means purchase return. So the purchase return amount of 10 rupees has not been recorded. Because of the purchase return, the creditor's account, the control account should come down. Even the ledger they have properly recorded, no? So then we will record the purchase return. We need to deduct that amount. So in order to come at the creditor's ledger balance, we need to deduct. In order to arrive at the correct figure, we need to deduct. Okay. Right, let's see the final answers. 600 plus 180 minus 60 plus 20 minus 10. Here I'm getting an answer of 730. So the creditor's ledger before the errors 730. 600 plus 180 minus 10. I'm getting an answer of 770. 770. Okay. So I'm getting the answer 770. 770. 770. Okay. Right. So we got the two answers, 730 and 770. Now this debtor creditor ledger related question in an A-level paper is very tricky, because you need to think and you need to figure out from where and where you are going and whether you should add or deduct. So you have to handle it very carefully. Okay, right. So under JMC V-Learning, today we did a accounting revision. The first paper, around 25 questions we have covered. So we will continue to do some revision papers so that you can get an idea, right? And you can get ready better for accounting papers, right? So thank you for joining. Please give us a comment that anything what you need and what sort of support you need, and share with your friends as well, right? So thank you for joining. I'm Sandeepa Jayasekera on behalf of JMCV Learning. Thank you.